Have you ever been in a situation where you bought a put and lost money even though the stock tanked? I know it sounds ridiculous, because shouldn't you earn money from a put when the underlying stock tanks? It so happened that I was scrolling through Reddit one day and I came across this post by the Reddit user RedbackOZ, where he posted weekly calls and puts both going down despite stock going down 8%. Can anyone who is a pro in options trading explain why this is happening and how to avoid this? Thanks. Okay, I will definitely not classify myself to be a pro for sure, but having traded options for a long time, this is my explanation as to why his puts lost money despite the stock dropping 8%. And I hope that through this video, you guys can also gain a better understanding as to how options work so as to crush it in the options market. Anyway, for those who are new to this channel, my name is Darren and I have been trading and investing in options since I graduated from university in 2008, and I created this YouTube channel to share my learnings along the way. So if you enjoy content such as this, then do subscribe to this channel for more of such videos. In order to understand how the user made a loss, we first have to understand how an option is priced. Most people just assume that when you buy a call and the underlying stock goes up, or if you buy a put and the underlying stock drops, you will definitely earn. I'm sorry, I hate to burst your bubble, but it is not that simple. And that, my friends, is the beauty of options. The reason for knowing what factors affect the pricing of an option is usually one of the main reasons why beginners to the option market lose money. Myself included, we have to understand that an options premium is derived not only from the price of the underlying stock, but also many other factors as well. And it is through those other factors that has resulted in this Reddit user to lose on both sides of the trade. Here are the 5 factors that can influence the price of an option. The first and obvious factor is the price of the underlying stock. Most people who trade options obviously know this and expect to earn when the underlying stock goes in the expected direction. The second factor will be the volatility of the underlying stock. Basically, the more volatile a stock, the higher the premiums that you will have to pay to purchase that option. And this affects your break-even price. Looking in the comment section of the Reddit thread, a vast majority of users are well aware of this, with many commenting the term IV crush. IV here refers to implied volatility. The IV crush is a scenario where the implied volatility decreases very quickly, and this usually happens once an event has passed, with the most common being earnings release. Thus, you'll see that most people lose money from their options after earnings is released, despite guessing the correct direction. This is because the stock did not generate a strong enough move in the correct direction to generate a profit. The reason for this is because this stock with earnings coming up can result in it being very volatile by nature, and all that volatility is already priced into the options premium. Therefore, volatile stocks naturally come with a much higher premium. Hence, the Reddit user should have calculated his break-even, and if the stock had no chance of clearing that break-even upon the option's expiration date, then it will naturally not be profitable. But while I do agree that they might be right, I do think that there are other factors that contributed to the put being in the red, with the most important being the third factor. By the way guys, I just want to quickly share my technical screener Marketclub. It is a screener that allows you to find bullish and bearish stocks and crypto in just a few clicks. In addition, it provides entry as well as exit signals, thus eliminating the emotional attachment to a trade. You can also monitor your trades by placing them into a watch list, and this helps you have a good idea as to whether the trend is still in your favor. You can try Marketclub for 30 days with just $1 by using my affiliate link down in the description below. And with that, let's head straight to the video. Time decay. This is because the Reddit user purchased a weekly option not knowing the effects of time decay. The appeals of a weekly call and put are is cheaper. Let's look at an example now. Let's say you are bullish on Tesla. If you buy the call that expires in 308 days for a strike of $880, it will cost you $189.50, making your upfront premium to be $18,950. However, if you bought the call expiring in just 7 days time with the same strike, it will cost just $18.25, making your upfront premium to be just $1,825. When I was trading in the university, I funded my options brokerage account with $2,000 just for fun. Looking back, $2,000 to trade options, that is basically the recipe for disaster. I'm saying this because if I were to buy a call with more than 6 months to expiration on a decent stock, I will most probably have used up 50% to 100% of my account in just that one single trade, thus making it a make or break trade. Therefore, to go around this, I will buy calls with just days to expiration, and while the action was definitely fun, I felt that I was gambling my money away as there was just too little time to be right, as the underlying stock were not able to trade beyond the break-even price. So in summary, that full $2,000 was lost. But what I gained were lessons on what not to do to increase your chances of winning. By the way, please give this video a like if it's helping you in any way. To understand the effects of time decay, we have to understand how theta works. Let us look at the weekly chain of Tesla. As you can see, this is the options Greeks. I will encourage those who are new to options to understand how the Greeks work, in particular delta and theta, as it gives you a much clearer picture into options in general. Let's look at these two Tesla option chains. You can see that for a Tesla call with a strike of $880, the one expiring in 7 days time will lose $157.67 a day per position, and this value will only keep going up as the option loses more and more time. However, the options expiring in 308 days will lose $30.26 a day per position. The thing about time decay is that it will keep eroding away an options premium at a faster rate as the option reaches expiration, as you can see from this chart. Hence, buying weekly options is a surefire way to lose money in the long term. Sure, you may get lucky once in a while, but unless you're an options god, all it takes is just that few bad trades to wipe off all your gains. The fourth factor will be the strike of his option. If he went purely by premium, he most probably would have chose a weekly option contract that is far out of the money. Thus, despite the stock dropping 8%, his put contract could still be out of the money, and factoring in his time decay that is already working against him, that could be why he is not profiting despite buying both the calls and puts on the same stock. The last factor that determines the value of an option is interest rate changes. While I honestly doubt this is the case, it is worth knowing just for fun. If we were to look at the options Greeks, we will come across the rho. The rho measures the impact of a change in interest rate on an option price. It indicates the amount the option price will change for every 1% change in interest rate. Let's take a look at this option chain of Tesla and use the call option with a strike of $870. Looking at the rho of Tesla, you can see that for every 1% change in interest rate, the price of the call option will go up by 0.0843. Honestly, I do not think that the rho had a major impact on the option pricing as compared to the other factors, so I will not dwell much into this. By the way, this comment made me a little sad. To be honest, if you were to take some time to understand how options work, you will realize that options can really be a useful tool to give you exposure into a bullish play with really very little capital upfront. In fact, this video over here will definitely help you in your options journey, so do check it out.